Welcome back to Stat Plus, your trusted source for in-depth analysis of India's economic trends. Today's episode dives into an urgent issue in India's financial sector that's gaining attention from regulators and market observers alike. We'll explore the challenges facing non-banking financial companies, or NBFCs, their aggressive growth strategies, and the potential risks these developments pose to both retail investors and borrowers. We'd love to hear your thoughts on the issues we're discussing today. Please share your perspective in the comments section below. Stay with us as we unravel the complexities of India's evolving financial ecosystem. The Reserve Bank of India's recent monetary policy meetings have highlighted concerns about the aggressive growth policies pursued by non-banking financial companies. The central bank has raised issues about unsustainable business practices, inadequate risk management frameworks, and the imposition of high interest rates and penalties by some NBFCs, particularly in the microfinance and housing finance sectors. A key issue highlighted was the push effect in retail credit growth, where lending is driven by business targets rather than actual demand. This often puts pressure on NBFC agents to meet aggressive lending targets, which can result in less thorough vetting of borrowers' creditworthiness. Moreover, performance-linked compensation for these agents can create misaligned incentive structures, encouraging riskier lending practices to meet targets, while conventional wisdom suggests that need-based loans, especially those sought during financial distress, are riskier than push loans. This may not hold true for NBFC lending. NBFCs typically serve underserved segments and are therefore prone to misjudging the borrower's repayment capacity even when credit scores are available. Despite the widespread adoption of credit scores in India, a significant portion of the population remains new to formal credit systems or outside them entirely. CIBIL data from 2021 suggests that over 420 million customers had a credit score, which is approximately 30% of the population, but only 170 million had an active loan, which is just 12.3% of the population. This indicates a significant level of credit invisibility, complicating accurate assessment of repayment capacity. Moreover, informal loans, which account for approximately 31% of total borrowing in rural India, as per a recent RBI report, are not captured by credit scores, further clouding the risk assessment picture. One contributing factor to these aggressive push strategies is the regulatory pressure NBFCs face. The RBI has made it increasingly difficult for NBFCs to secure input financing from banks, forcing them to adopt high-risk strategies to maintain growth. Bank financing to NBFCs has reduced significantly, with year-on-year growth declining from 21% in August 2023 to just 12% in August 2024. In response, NBFCs have adopted a cyclical growth strategy, raising capital through non-convertible debentures, or NCDs, using these funds to issue more loans, then leveraging these new loans as collateral for further NCD issuances. This strategy has fueled remarkable growth, with NBFC personal loans surging by 38% year-on-year in Q1 fiscal year 25, significantly outpacing the system-wide growth of 18%. However, as bank lending to NBFCs decelerates, with growth slowing down by approximately 45% year-on-year in August 2024, and banks retreat from high-risk lending in general, NBFCs face mounting challenges. Banks are becoming more selective in their lending, potentially cherry-picking the best credit opportunities. This leaves NBFCs with lower quality credit prospects. Over time, this trend could lead to a deterioration in the overall asset quality of NBFCs. This scenario puts retail investors in a vulnerable position, as they may unknowingly take on more risk when investing in NCDs directly. NCDs are typically secured by a dynamic pool of loan receivable, meaning the specific assets backing the debentures can change over time. While this approach has driven impressive growth, it carries inherent risks. As NBFCs continuously issue new NCDs and add new loans to the asset pool, the overall quality of this pool can gradually decline. This gradual degradation often goes unnoticed as the change happens incrementally, masking potential long-term risks. Consequently, the credit rating assigned at issuance may not hold throughout an NCD's tenure, exposing NCD buyers to unforeseen risks as the underlying asset quality shifts over time. The RBI's crackdown on banks' lending to NBFCs has resulted in a regulatory paradox. While the central bank's restrictions aim to mitigate high-risk loans, they have inadvertently led to a dual-risk scenario. On the supply side, NBFCs raise input capital. The risk has shifted from banks to retail investors, as NBFCs increasingly rely on public debt through issuance of NCDs. On the demand side, that is, when NBFCs lend, stress has mounted on borrowers, who may not have the capacity to manage loans extended through aggressive push strategies. As we've seen today, the RBI's crackdown on lending to NBFCs and the challenges facing these financial companies present a complex scenario with far-reaching implications for India's financial sector, retail investors, and borrowers. If you found this analysis valuable, please like, share, and subscribe to our channel for more in-depth explorations of India's economic pulse. And don't forget to share your thoughts in the comments. Do you think NBFC's growth strategies are sustainable, or are they setting the stage for a future financial crisis? Until next time, this is Stat Plus, helping you decode India's economic future. Stay informed, stay ahead.